Good morning. Also, thank you for joining. Today, we are going to discuss why April is the most critical month for HNI portfolio strategy. So, for an HNI investor, April is not just another month, it is the reset point for how your portfolio is positioned because what you do in April often influence the outcome for the entire year. But if you see, this year is slightly different because the environment has changed. We are not coming from a pace of strong broad-based returns. We are coming from a pace where macros were relatively supportive, but market performance was very uneven. So if you see markets are reacting faster, global risk are increasing, and valuations also start to adjust. So which means continuing with last year's approach may not work the same. So that's why this conversation becomes most important. So not just about where markets are, but how portfolios should be positioned in FY27. So what typically changes in a new financial year? Let start with the first step, taxes. Now, every financial year, we start from the zero again, which means every decisions you make from this point directly impact your net returns for the year. And this is where most of us go wrong. They don't plan at the start; they react at the end. So they wait till March and rush the decisions and compromise on quality. But disciplined investors do the opposite. They use April to plan and not panic. And for HNIs, this matter even more because small inefficiencies in decisions translate into large difference in outcomes. So the second changes are very important. April gives you a fresh starting point. You stop looking at what happened last year and you start asking what is the current environment, what has changed, and what I should do differently now. And this is also the pace where the new union budget announcement and policy changes and reflecting into the system. So the environment you are investing today is not the same as last year. Some changes will happen. So and also because markets don't reward the past performance, they reward the current positioning. And if your portfolio is still aligned to last year's conditions, you are already on step beacon. So April is not about continuing; it's about starting with the right alignment. So and then comes to the most important shift is behavior. At the start of the year, everyone feel optimistic. We want to take action. We want to improve. But without a clear framework, that action turns into mistake. So some investors over allocate to what recently performed and exit what feels uncomfortable or keep changing direction frequently. So it's not the market that creates the pressure. It's our behavior that amplifies. So the biggest risk is not the volatility. It's inconsistency in our decision. So when you combine everything, you have a fresh starting point and changing environment and the shifting behavior. This is exactly why April becomes crucial. So what is different in FY27? To understand this, we need to look at what happened last year. So last year, you see inflation was gradually cooling down, even goes below 2% and going up slightly, but still in the comfortable range of around 3% in the last reading. So it's a well-managed situation. And interest rates after a pause, we started seeing some sign of cuts last year, and credit growth was strong. Banks were lending, and overall liquidity in the system also very supportive. So on GDP growth also remains strong. India continued to be one of the fastest growing economies, and geopolitics, well, it's always present. Last year the largely around tariff discussion and global trade tension going around. So overall, last year was relatively stable. Now compare that we enter into FY27 because if you see inflation expectations are become uncertain again, especially with rising global risk. Interest rates are not no longer clearly moving in one direction. The path has become unpredictable. Credit growth may not remain as strong because higher uncertainty impacts both lending and borrowing decision. And GDP growth will still be strong, but it may not be smooth as before. And the biggest shift happening is the geopolitical war kind of tensions. We are now dealing with active global conflicts, not just trade tension. And this has a direct impact on our, oil prices, currency movement, inflations, and overall market sentiment. So unlike last year, this is not a stable environment. This is a market where multiple variables are moving at the same time. So that's what makes FY27 different. It's not about one risk. It's about everything moving together. So now we can see some of the key challenges which is ahead for our FY27. So let's start with first challenge oil. First, if you look at maybe this may look like just another commodity just, but oil is not just a commodity. Oil is one of the most important input for the entire global economy. If you look at this chart, for most of the year, prices were moving in a relatively stable range. There were ups and downs, but nothing extreme. And then suddenly you see a sharp spike. Now this kind of movement usually does not happen without a reason, and the reason today is largely the geopolitical tensions. When conflicts increase, especially in regions connected to the oil supply, the market immediately starts pricing the risk, not actual shortage, but the possibility of disruption. And that is enough to push the prices even higher. Now, let's bring this closer to India. India imports a large portion of oil, which means we don't control the price, we are observing the price. So when oil moves up globally, the impact directly flows into our economy. Now, think about where oil is used, transportation, logistics, manufacturing, power generation. So even something as simple as getting grocery to your house, it's depending on the fuel cost. So when oil prices rise, it doesn't stay limited to one sector. It's spread across the system. Now, what happens is company may start facing higher input costs. Some companies observe it, but most companies pass it on to the customer. That's where inflation begins to rise. Now, once inflation starts rising, the central bank cannot ignore it because inflation affects purchasing power. So instead of cutting the rates, they may hold rates higher for longer or delay any easing cycle. So higher inflation, higher interest rate, both together start slowing down the demand. So because borrowing becomes expensive, spending becomes cautious, and business expansion slow down. So from an investor perspective, this creates a chain reaction. So companies' margins get impacted, earning expectation can change, valuations comes under pressure. So markets become volatile. Now let's bring it back to the current situation with ongoing global conflicts, oil supply goods production expectations, and geopolitical stability. All of these are uncertain, which means oil is not just rising; it is becoming unpredictable. And unpredictability is more dangerous for the oil prices because it makes planning difficult. So this is not just oil going from 70 to 100. This is about the system becoming unstable. So that is why oil becomes the biggest challenge for us in entering into the FA27. So second challenging we see is the rupee. If you look at the chart, the movement looks gradual. There is no sudden spike, but that's actually what makes it important because currency depreciation is often slow, but its impact is deep and long lasting. Now let's simplify this. If earlier $1 was around $85, rupees, now it is moving to 90 plus. So that means we need more rupees to buy the same dollar. So now why does this matter? Because a large part of India is consumed, is linking to the global pricing, especially oil. So now think about this combination. Oil prices are rising globally, and at the same time, the rupee is weakening. So even oil prices stay the same, we still end up paying more because of the currency. So this creates what we call a double pressure. So global prices increases plus currency depreciates. Now if you go one level deeper, a weaker currency also affects the capital flows. Global investors continuously evaluate where should money go. If the currency is weakening, it creates a perception of risk. So some capital may move out or become more cautious. That affects liquidity in the market. So from a business perspective, it depends on import. Their costs also go up. So if they have a foreign debt, repayments have become more expensive. If they export business, yes, they may benefit, but overall stress still somehow increases. Now, from an investor's point of view, currency movement directly impact the returns, because especially for HNIs, because portfolio exposure is larger, even some small currency movement can significantly impact outcomes. So now, if you look at the current environment, when global uncertainty and money tend to move towards the stronger economies like US, which strengthen the dollar and put pressure on emerging market currency. This is not an India-specific issue. This is part of a global shift. That's why the rupee is gradually weakening. Now, the key point here is not the speed, it's the direction, because consistent depreciation over time erodes the purchasing power, it impacts inflation and adds pressure on our policy decision. So If you look at the third challenge, it is bond yields. Now, this is something most of us don't track closely, but it quietly affects everything. If you look at the charts, yields have been gradually moving higher, steady, and a consistent climb. Now, let me simplify what yield actually means. When you lend money to the government, yield is the return you get. So, when yield goes up, it means money itself becoming more expensive. Now, why this is happening? Because of the uncertainty. When inflation expectation rise, when global risk increases, investors demands higher returns to lend, and that pushes yields upward. Now, here is why this matters for everyone. Yields act as the benchmark for the entire economy. When yields moves up, bank loan rates goes up, home loan EMIs goes up, corporate borrowing cost goes up, the entire cost structure of the economy shift. Now think about what this does to the business. A company planning to expand now has to pay more to borrow. A project that looked profitable 6 months ago may no longer make sense today. So expansion slows down, hiring slow down, growth slow down, and this is where we are already seeing companies become more cautious because when money becomes expensive, every decision gets re-evaluated. Now connect this with what we discussed earlier. Now, if inflation is uncertain, oil prices are rising, currency is weakening, all of this put pressure on interest rate. That's exactly why yields are climbing. So this is not an isolated trend. This is a direct reflection of the macro stress we just covered. So what's on investor minds today? If you step back and observe, there is a clear shift in how we are started to thinking right now. The first thinking is a market performance. The recent returns have not been very encouraging. Volatility has increased, and markets are reacting to every global event. So naturally, confidence starts to come down. So the second thought is about safety. When uncertainty increases, the instinct is to protect capital. That's where fixed deposits start feeling more comfortable, not because they give higher returns, but because they feel very predictable and safe. And the third shift is around the market segments. There is a perception that the mid and small are still doing better. So investors start thinking, should I move there? Am I missing out? And this creates confusion. And finally, the bigger factor behind all of this is geopolitical uncertainty. Because today, markets are not just reacting to economic data; they are reacting to global events which are unpredictable by nature. So when you combine all of this, you don't just get volatility in markets, you get confusion in decision making. This is what most of us are dealing with right now. And now let's break down each of us in one by one. So first, if you see the market performance negative, and this is not just a feeling, this is visible in the data. If you look at the Nifty, it recently touched a peak of around close to 26,300 in nearly 2026. From there, it has corrected to nearly around 22,500 levels. That is roughly 12 to 14% correction from the peak. So now this is important because anything above a 10% fall is not just look like a volatility, it's look like a correction. That's exactly what we are experiencing today. So it's not just the index, the broader market is also under pressure. Mid and small caps which performed very earlier have started correcting. In fact, many stocks are significantly below their peak level. So some segments have seen sharp drawdowns and continued weakness due to valuations and earning pressure. So this is not a one segment problem. This is happening across the market now. Along with this, volatility also increased significantly. Markets are not longer moving in a clear trend. Instead, they are reacting to every piece of news. One day markets are up, next day they correct sharply, and this is largely driven by global factors. If you see what's driving markets today, it's not just earnings or our growth. It's things like geopolitical tension, oil price movements, the currency pressure, and the global liquidity. All of these are influencing market direction. So and these things are not predictable. So the key problem, because when something is predictable, investors can prepare. But when markets react to unexpected global events, it creates uncertainty. Now, from an investor's perspective, this creates a very uncomfortable situation because portfolios are not going at the same time. There is no clear direction, and that's where doubts start building. Should I stay invested? Should I reduce exposure? Should I wait? And this confusion is very real. But here's the important thing to understand: this kind of pace is not new to markets. If you look historically, corrections of 10 to 15% happen multiple times, even in strong bull markets, and many of these corrections have lasted for months, not just days or weeks. So what we are seeing today is not abnormal, but it feels abnormal because we are experiencing now, and that's where most of us make mistake. They react to recent performance instead of understanding the piece, because negative returns in the short term don't doesn't mean something is fundamentally broken. It simply means the market is adjusting to the new reality, and that's exactly what's happening today. And this is where the real decision making begins. So next is save money really growing? This is one of the most important question investment to ask today, because when markets become volatile, the natural instinct is to move towards safety, and for most of us, safety means FT. So because it feels stable, there is no volatility, no daily price movement, and there is no uncertainty. You know what you are going to get, and that creates comfort. But the real question is not comfort. The question is what is happening to your money over time. Let's take a simple example. 3 crore invested in fixed upon assuming a return of around 4.2% post tax, which means I am assuming 6% return. So post tax will be around 4.2%. So on the surface, it looks reasonable because there is no risk, no volatility, steady compounding. But you look after 10 years, this grows to around 400 crore. Now if we stop here, it look like your money has grown, but this is where most of us stop thinking. They look at absolute value, not real value. Now let's just adjust this after inflation, because over 10 years the cost of living increases significantly. What 1 crore can buy today will not be the same after a decade. When you adjust for inflation, that 4.5 crores is actually worth around 2.5 crores in today's term. So now also think about it. You started with 3 crore, and after 10 years in real terms, your money has actually reduced, not because of loss, but because it didn't grow enough. And this is the biggest hidden risk in FD. So there is no visible fluctuation, but there is a silent erosion. That doesn't mean fixed deposits are bad, because it serves as a different purpose. They provide stability, liquidity, and predictability. But the problem starts when they become the default strategy, especially in uncertain times, because investors are not moving to FDs based on strategy. They are moving based on fear. So, and the fear-driven decisions are often ignore the long-term impact. Now, in the current environment, with inflation, uncertainty, rising cost, and changing macro condition, this becomes even more important, because if your returns don't beat inflation, your wealth is not growing, it is just standing still or slowly declining. So the real definition of safety needs to change. Safety is not just about avoiding the short-term fluctuation. It is about protecting long-term purchasing power, and this is the question each of us need to understand. So not just is my money safe, but is my money actually growing? That is the important question for us. So if let's look at valuation, because after a correction, the first question all of us ask is, are markets now cheap? If you look at the data on the screen, there is clearly been a correction. Nifty is moved from 21 to below 20. Mid caps have corrected around from 33 to 30. Small cap also come down from close to 29 to around 26. So on the surface, it feels like valuations have become more reasonable. But to understand this properly, we need to look beyond just the recent. Let's start with Nifty. Currently, Nifty is just around 19.6. If you compare this with 1 year level, it's around 21. This is a clear correction. But if you look at the long-term range of 2022, Nifty is now close to the fair valuation zone. So large caps are not expensive anymore. So they are close to the reasonable level. Now look at the mid cap. Mid caps have corrected from 33 to 30. So yes, there is a visible correction. But if you compare with the long-term range of around 20 to 24, they are trading well above the historical level, which means even after the correction, they are not cheap. They are just less expensive than before. Now coming to small cap also connected from around 29 to 26. Again, on a short-term basis, this look like a good fall. But if you compare this with the long-term range of around 16 to 20, they are still significantly above the historical averages. So here also we are not in a cheap zone, we are in an normalizing phase. So this is where most investors gets confused, because after a correction, everything start looking like an opportunity, but markets don't move from expensive to cheap immediately. They move from expensive to fair and only then to cheap. And right now, most segments are somewhere between expensive and fair. So yes, valuations are corrected, but that is doesn't mean markets are available at a deep discount. That this is exactly why approach becomes very important, because in this space, returns don't come from the broad market movement. They come from the right selection and discipline. So let's now look at the drawdowns, because one of the biggest concerns we have today is how much can markets fall, and more importantly, this is what we are seeing now is unusual. If we look at the charts, we are comparing three different cases: 2018 correction, 2020 the COVID crash, and the current pace. Let's start with 2018. Was not a global crisis. There was no major event like COVID yet. Market corrected. Nifty fell around 10%. Mid cap and small caps fell even more. So even in a relatively normal environment, markets went through the meaningful correction. So if we move to 2020, this was an extreme event. Nifty fell close to 37%. Mid cap is more, and small cap has corrected around 43%. This was a short panic-driven fall, but what happened here is not just the fall; it is the scale of drawdown across segments. The smaller the segment, the deeper the fall. And now let's look at the current pace. Nifty is down around the 14 to 15%, and mid cap around 13%, and small cap also close to 22 to 23%. So clearly the markets are correct. But if you compare this with previous cycle, this is not extreme. This is somewhere in between. But even severe area, this is a correction like these are part of the market cycle. They are not expansion. They are happening regularly, and more importantly, different segments behave very differently. So large cap tend to fall less, mid cap fall more, small cap fall the most, and this pattern is consistent across the cycle. So when we look at the current drawdowns and we feel uncomfortable, it is important to understand this is not unusual. This is how market function. So now, if you see will market fall, because market always go through the correction. So the real question is, are we prepared for this kind of movement? Because if your portfolio is not aligned to your risk tolerance, even in a normal correction can look like a big problem. That is where most of us makes mistakes today. So because we don't exit at the peak, we started to exit during the drawdown, because that's when the discomfort is very high. So this data is not just about the past correction, it's about the setting the right expectation. The kind of volatility is normal in the equity market. The drawdowns are the part of the journey, and the different segments carry different level of risk. Once you understand it, this decision making becomes much clearer. So now look at how markets behave during the major global events, because today a lot of decisions are being driven by headlines or conflict uncertainty. Even every time something like this happens, markets react immediately, and that reaction is usually on the downside. You can see it across events on the table. 9/11 and Iraq war and 26/11, Russia, Ukraine, difference even same first reaction. Short-term impact is almost always negative. That's what creates fear. That's what makes investors uncomfortable. But here's where the perspective changes. If you move beyond the first reaction and look at slightly longer period, the pattern is very different. At the 3-month level, many of these even show recovery. At the 1-year level, the majority of the cases have delivered positive returns. In fact, out of the 10 major events, 8 have resulted in a positive returns within a year. So, and the average return is around 23%. Now, that's a very important point, because it tells us something fundamental. Markets don't ignore the event like this, but they don't stay stuck in the zone either. They process the impact, adjust the expectation, and then move forward. Now extend that further, the three-year level returns are even stronger, which means over time the influence of this event reduces significantly. Growth, earnings, and fundamentals start taking over again. Now bring this back today. What we are experiencing right now is not new. The triggers may be different, but the behavior of markets has been consistent over time. So the challenge is not the event itself. The challenge is how we respond to it, because most decisions are made based on what is happening right now, not based on how things evolve over time. And that's where the mistakes happen, exceeding during uncertainty and missing the recovery that follows. So short-term reactions are the part of the journey, but long-term outcomes have been far more consistent. And once we understand this, we stop reacting to the every event and start focusing to staying aligned to our goals. So now coming to the important point, like what is the equity outlook? After everything we have discussed, obvious thing in our mind is what are we headed from here? The first thing to understand is India is still growing at a faster pace compared to the most of our global peers. Whether it is GDP growth or corporate earnings, India continues to stand out. So structurally, the growth story remains intact. That hasn't changed. Now at the same time, we have gone through a correction, and because of that, valuations are definitely better than before. Markets are no longer at the same stretched levels we saw earlier. So from that perspective, this space does create opportunity. But this is where a very important distinction comes in. But better valuations don't automatically mean good investment, because even after the correction, not everything is available at attractive level. So some segment are still adjusting, some business are still expensive, and some are still driven more by sentiment than fundamentals. So the risk here is not the market. The risk is our selection. So another important shift is in how markets are behaving. Reactions have become faster. Any global event, any macro change get reflected very quickly, which means price movements can be sharp, not because fundamentals are changing overnight, but because expectations are adjusting. And this is likely to continue. So instead of expecting a smooth upward trend, it is more realistic to expect phases of movement like this, ups and downs and some adjustments and the frequent changes in sentiment. In such an environment, our broad-based returns become less likely. So earlier, many segments move together. Now performance will be more selective, which means outcome will vary based on the. So investments, some investments will do well, other may not deliver as expected. So India's growth story is still strong, and the corrections has made valuation more reasonable. But this is not a pace to be casual about decision, because the difference between a good investment and a poor one can be significant, and that is where the approach becomes critical. So not just being invested, but being invested in the right places. So now coming to the fixed income, because in a case like this, debt becomes equally important in the portfolio. The first thing to understand is, so when yields are trending higher, if you look at the recent movement, there is being a clear upward shift, but at the same time, there is no clear direction. Yields are not moving in a straight line; they are moving with uncertainty, and that uncertainty coming from the multiple factors. Inflation expectations are not fully settled, global conditions are changing, and policy decisions are becoming more data dependent, which means the path of interest rates is not very clear earlier. There was a strong view that rate would come down. Now the clarity is not there. This is where this second point becomes important: uncertainty in the rate path. Because when you don't have a clear direction on rates, it becomes difficult to take aggressive position, especially in a long duration strategy. Now, if we simplify this, duration is essentially means how sensitive your investment is to interest rate changes. If you take higher duration exposure, you benefit when rates fall. But if rates move the other way or remain uncertain, the same position can create the volatility. And that's why in the current environment, taking aggressive duration bets can be risky. Not because a debt is risky, but because the direction is not clear. So the focus needs to shift from trying to maximize returns to maintaining stability. Because in a portfolio, fixed income is not just about returns. It plays a different role. It provides balance, it reduces overall volatility, and it gives predictability. And that role becomes more important when equity markets are uncertain. So debt is also still relevant, but the approach needs to be disciplined, avoid aggressive positioning, avoid chasing short-term opportunity, and focus on building stability. Because in this space, consistency matter more than chasing the returns. Now, after looking at all this, one question naturally comes up: should I wait for clarity, or wait for stability, wait for the right time to invest? So this is where a very important reality comes in. Equity returns are not always linear; they don't grow steadily year after year. A large part of long-term returns comes from a few critical days in the market. If you look at this data, if someone invested 10 lakhs over a long period in 1999, 50, it's close to around 3 crore. But now look at what happens. If you just a few best days, miss 5 days, returns drop significantly. Miss 10 days, they fall even further. And if you miss just 15 best days, your portfolio loses almost one third of its value. So this is a huge difference. And beyond that, the impact becomes even more severe. And here is the most important part. This best days are don't come during the calm periods. They usually come around the most uncertain pace in the market. In fact, some of the best days in the market happen very close to the worst days, which means if you step out during difficult times, you are very likely to miss the recovery pace. So, and that creates a permanent impact on our return. So, the challenge is not just about timing correctly. You have to uh, get two decisions right: when to exit and when to re-enter. And doing both consistently is extremely difficult. That's why staying invested becomes more important than timing. So, because missing just a few key days can change long-term outcomes completely. So how I thought help investors navigate this environment. So how do you navigate an environment like this? At I thought our focus is not on predicting market, it is on positioning portfolios to handle different outcomes. The starting point for us is asset allocation. In a pace where multiple factors are moving, we don't rely on a single asset classes. We build portfolios that are balanced across scenarios, because equity will go through correction, debt will go through uncertainty, because, but the portfolio as a whole should remain stable. So the second part is how we handle behavior. Most portfolio damage doesn't come from the market, it comes from the reaction. So instead of reacting to every event, our approach is to stay aligned to a clear strategy. So filtering noise and focusing only on what actually really matters. And the next thing is how we look at the market movements. We don't see uncertainty only as a risk, we also see it as an opportunity. Corrections allow better positioning, price dislocations create every point. So, but only when approached with the discipline, that's where the structure becomes very important. Because without structure, the same movement leads to the inconsistent decision. And that brings up to the final important point: portfolio construction. So every allocation has a role, every investment has a purpose, and the overall portfolio is aligned to long-term outcomes, not the short-term triggers. So because once the structure is clear, decision making becomes much simpler. So the approach is not about getting every call right. It is about building a portfolio that can navigate different environments and staying consistent with it. So before you ask this question, so before making any investment, a simple framework helps avoid most mistakes. The first question is, what is the downside risk? So every investment has upside potential, but not every investment has a controlled downside. So understanding how much you can lose is as important as knowing how much you can gain. Because in uncertain market, risks show up faster than return. Then next, the second question is, what role does this play in my portfolio? Not every investment is meant to generate high returns. Some are meant for stability, some for growth, some for balance. Without clarity on role, portfolio become a collection of some random decisions. So, and that creates inconsistency in our portfolio. And the third question is, what actually drives the return here? Is it earning growth? Is it valuation expansion? Is it macro factors? Because if you don't understand what is driving the investment, it becomes difficult to stay invested when things don't move as expected. And finally, how long should I stay invested? Every investment has a time horizon. Some requires patience, some are shorter term. But if the time horizon is not clear, decisions become reactive. and most exits happen before the investment actually plays out. So these four questions act as a filter. They don't guarantee returns, but they reduce the mistakes in our investing. So avoiding mistake is often more important than chasing the opportunities. So up to the point we look at the environment, the risk, and our portfolio needs to be structured. The next question is how do you actually implement this? Uh, because ideas are one thing, execution is what creates outcomes, and this is where our portfolio strategies comes in. So these are our PMS offering. So our PMS offerings are designed to address exactly this kind of, not by predicting markets, by building portfolio that can adapt to the different conditions. So each strategy has a clear law of, starting with a solitaire. This is designed to bring balance. It combines a large, mid, and small caps, but focus on your risk adjustment. And the idea is not just growth, but managing downside along the way. Then comes the large cap strategy called True Blue. This is focused on stability, a defined universe, high quality business, and no unnecessary risk taking. This becomes important when markets are uncertain because large caps tend to be more resilient during volatile phases. On the other side, we have the small cap strategy called Vriddhi. This is more selective, more research driven, and focusing on identifying business that are not yet widely discovered. And this is also where discipline matters most because not all small caps can deliver, and selection makes a significant difference. Then comes the multi-asset strategies where allocations play a bigger role. Instead of relying only on equity, it dynamically adjusts across asset classes based on macro condition, risk level, and overall market environment. This helps in managing fluctuation while still participating in the growth. And finally, a product called Yo strategy specifically designed for NRIs with a similar multi-asset approach, but aligned to the specific requirement. Now, across all this strategy, the common theme is simple, the clarity of role, and each portfolio is built with a purpose and not as a collection of ideas. Because in a market like this, random allocation doesn't work. Structure matters, discipline matters, and consistency matters. The focus is not on chasing returns, but on building portfolio that can perform across the different phases. So along with PMS, we also have another thing which is designed differently. This is called M2W milestones to wealth. It is our mutual fund distribution based model built with a very specific purpose to help investors move from where they are today to their first 1 crore and beyond. So the idea is simple, not just investing, but creating milestones. Because for many investors, the biggest challenge is not only make wealth, it is about direction. So when to start, how much to invest, how to build over time. That's what M2W is designed to solve. It's provide a structural pathway using mutual funds with clear allocation, clear progression, and clear outcome. Now this approach was primarily designed for investors who are starting their journey or building their portfolio gradually because it brings discipline and it focuses on long-term wealth creation. But at the same time, this is not limited to small investors. Even for HNI is already invested through PMS, M2W can play a strategic role, not as a replacement, but as a complement. For example, it can be used for some tactical allocation, taking exposure to some specific opportunities, adjusting positions based on market basis, or managing certain parts of the portfolio with more flexibility. Because mutual fund allows very easier execution and diversification. So in that sense, M2W becomes a flexible layer within the overall portfolio. So now across both PMS and M2W, the philosophy remains the same: clarity, structure, and discipline. Only the approach changes based on the investor's requirement. So that's from my side. If you have any questions, kindly put it in the chat box.
Thank you, guys. We can meet in the upcoming webinar. Thank you.